Welcome, everyone. This is day 2 of our video series, 17 Days of Gen Z and Mortgages. We have a lot of information to cover today, so let's get right at it. Navigating the world of real estate and mortgages can often feel like a strategic board game. For many Gen Zers, the pressing question isn't just about how to play, but how to make that winning move. Today, we dive into the all-important question, how do I qualify for a mortgage? During our journey, we will give you some action items and suggestions to help you. So open a notebook and jot these down and keep this handy as you navigate your mortgage journey. A bank or a lender is like a detective piecing together the puzzle of your financial life. It's not just about one factor, it's the whole picture. Remember, your past financial behavior is often a prologue to your future. First, let's do a brief overview of the qualifying factors a lender will look at when pre-qualifying you. Qualifying for a mortgage is like passing a multi-level test. First, lenders will assess your credit score, which is a numerical representation of your credit worthiness. A higher score can lead to better loan terms. Next, your employment history and income come into play. Lenders want to see stability, meaning a steady job and consistent income over the past 2 years. The next consideration is your debt to income ratio, which is all of your monthly debt payments plus your proposed new house payment divided by your gross monthly income. Lenders typically prefer a ratio at or under 43%, although some loan programs like FHA allow a higher DTI. You can find online DTI calculators to gauge your debt to income ratio. Again, aim to keep it below 43% to maximize your mortgage options. Set up a meeting with a financial advisor or mortgage consultant to review your income versus expenses and identify how you can improve your financial health. Prepare for the meeting by jotting down specific concerns, goals, or questions. Post-meeting, summarize the key takeaways and set actionable goals based on the advisor's recommendations. Additionally, lenders will scrutinize assets like checking, savings, and investment accounts. Your down payment amount and its source are vital. They prefer legitimate, traceable sources. They will also request the source of any large deposits into your bank accounts within 60 days of putting in your application. If you are a first-time homebuyer, the lender will look at your past rental history. Make sure you have a record of on-time rent payments. After you find a potential home, the lender will then look at property value, location, and whether it's a single-family home or a multi-unit property. The lender will also consider your total monthly payment when qualifying you, which is determined by the current interest rates, future property taxes, and homeowners insurance, and private mortgage insurance when it's required. Let's discuss private mortgage insurance, or PMI as it's called. It's crucial to have a proper understanding of this program. If you're paying less than 20% down, private mortgage insurance protects the lender in case you default on the loan. Some loan programs allow the PMI to be canceled after a certain period of time. Other programs do not. This is important to understand when selecting a loan program. There are other fees to consider when obtaining a mortgage, including appraisal fees, closing costs, and title insurance. Also, ensure that you are informed about escrow accounts for future property taxes and home insurance when they come due. Always check for any hidden fees or charges in your mortgage agreement. Lastly, maintaining a transparent, honest relationship with your lender can ease the process. Be honest and upfront about your financial situation. The lender will find out eventually in the end. Before applying for a mortgage, there are steps you can take to expedite your application. Begin to compile all of your past financial records for the past 2 years or 60 days in the case of bank statements. They'll want to see W-2s and 1099s, copy of your driver's license and social security card, and any other financial commitments you might have. Those could be things like child support payments ordered by the court. You can keep these in paper form or digitally. When you apply for a mortgage, your consultant will request all the above documents and possibly more according to your situation. This will help your lender see your financial history clearly. Real quick, let's discuss your credit score, which acts like your financial fingerprint and will have a major impact on your loan type and interest rate. The higher it is, the more doors it opens. Check your credit score online directly through a major credit bureau. I don't recommend Credit Karma. By law, you are entitled to one free credit report per year from each of the three credit bureaus. Look for areas of improvement and discrepancies in your credit report. Your quest to qualify for a mortgage is a blend of many elements, a mosaic of financial discipline, awareness, and a touch of savvy planning. When the pieces fall into place, the labyrinth of mortgage qualification will lead you to the treasure, which is your dream of home ownership. Our next episode is day 3, where we talk about the difference between a fixed rate and adjustable rate loan. If you have more questions, be sure to reach out to us via direct message. Thanks for joining us today. I'm your host, John Collins. Have a great one.